Good afternoon. Today is Monday, January 8th. I'm Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri. This is our first video of 2024, and we certainly have a lot to talk about. But the first thing I'd like to do is review 2023 because it's very important. 2023 saw a nice comeback in prices for such averages as the S&P 500 and the NASDAQ average. However, what it did not do is really make a cumulative rate of return into a significant positive area. So let me ask you, Russ, give us some figures here, because what it means in simple English is in the last 2 years, people that have been in these averages in stocks and or bonds, or even worse, 2 years has gone by and they've made no money. True?
True. I think, Joe, clients are starting to realize their accounts are flat down over the last 2 years. If you really even consider money taken out of the accounts for withdrawals. Secondly, we know that the S&P 500 peaked on January 4th of 2022. That return from January 4th of 2022 through the end of last year on a price basis is actually slightly down. The triple Q ETF, representing the NASDAQ 100, one of the better investments people believe, over January 4th of 2022 to December of 2023, that has returned plus 2%. Also, if you're looking at 60-40 portfolios, some well-known balanced funds actually have returns that are minus 4%. So if you're a client and you're waking up on January 1st of 2024, looking and reviewing your accounts, you're starting to realize things might not be going so well.
Yeah, that's one of the things we've done for over 40 years, is make sure that we don't have the big down years. Yes, if you can catch an S&P last year when it was up 24% or whatever it was, that's great. But the problem is the previous year you were down 18%, you have no cumulative rate of return. Our accounts last year were up double digits, based upon very small 2 and 3% losses in 22. We're at all-time high water marks for these accounts in amounts that are positive. You compound that off this year, which we'll talk about here in just a minute of why this might be the third year in a row for flat to negative returns for the various popular averages. But if that happens and we make another positive return for this year based upon the high water amounts that our portfolios have, compound that again, it all makes it almost impossible for the very aggressive funds to ever catch up with us. So maybe we should switch and chat for just a few minutes about what we think is the outlook for 2024. Dallas, our investment committee has agreed on this scenario about interest rates. Why don't you explain what our outlook is and why our outlook is this way for interest rates?
Sure. We feel right now that markets are a little too optimistic about coming interest rate drops. We feel that inflation is going to be a lot more stubborn than what they are saying, and that interest rates are going to stay higher for longer. You brought up the different indexes that are flat or negative. Most of those indexes are geared primarily towards stocks. Well, most people have a balanced portfolio, so individual portfolios are not even seeing that break-even point. So, Dave, I'd like to just ask you, when somebody's got a balanced portfolio and interest rates stay higher, longer, inflation still is stubborn like it has been, what do you see happening with markets next year?
Well, as we sit here today, the markets are expecting significant rate cuts by the Federal Reserve. Maybe 3 cuts. Some people are even saying 4 or more. And given the current economic conditions, employment is like 3.8%. GDP is positive. Inflation still is sticky above 3%. I don't see how the Fed could or should cut rates. Their mandate is full employment and controlling inflation. They have full employment, jobs are strong, inflation is still sticky. And so in the way the market is pricing itself, if they do not cut rates, equity markets should sell off because there is an alternative. Would you rather have over 5% in a guaranteed short-term treasury, or would you rather have a potential 8% in equity returns? When you can capture 75% of the equity return without any risk, you have an alternative. And that's going to attract money. I think it's a very simple decision.
I know the markets have this set up for the Fed's going to start cutting interest rates in March. They're going to be very aggressive cutting interest rates. We disagree. We think 24 is another year. Be careful. The markets had big rallies in the last 2 months of last year on this concept of we're going to have a soft landing, the economy will be strong, we won't have any disruptions around the world in political events, the Fed will cut interest rates and everything's going to work perfect. We're not convinced of this, and this might be the third year in a row for negative returns. It's what really over the 40-some years has separated us from the way other people manage money. We're not worried about outperforming the S&P 500 year to year. We're more concerned about cumulative returns in client portfolios, and are we continually getting to new high water marks. And we're very pleased that last year in 23 we fulfilled that, and our clients are solidly in the black at new high water marks. So we'll be back in a few weeks. Corporate earnings are going to be coming out here very quickly over the next 2 to 3 weeks. Let's see what they are. Let's see how they comment about what they see for the balance of the year, and we'll be back with another update. Thank you for tuning in. Brian Curtis, our very capable producer here of these videos. Thank you, Brian. By the way, Happy New Year to you and your entire family. Thank you.